In my book, I recommend a pyramid approach, which is similar to what you're saying. So the base of you want to start at the base of the pyramid. The pyramid is wider, so you want to have more allocation at the base. So you start at the base and you want to de-risk your portfolio, diversify your portfolio. So I recommend physical, starting with physical, and then use physical as a base, and then use ETFs and mutual funds. So I have 6 ETFs and 3 mutual funds and physical. So a very strong base. And so because you're going to get a lot of volatility, I believe that a base is really useful. Now, I was doing this over years and years and years. And I tried to find a book on the subject, and there wasn't anything. Literally, I was shut out. I mean, I had to learn it all on my own. And so from 2004, and the only thing that I wanted to invest in was gold and silver mining stocks. I had no interest in the stock market. At that point in 2004, it was my belief that the U.S. government and U.S. economy was basically heading down a path of no return, kind of a fait accompli situation, where we were going to live on debt and we were going to generate our standard of living and everything basically based on debt. And I thought that was kind of a non-starter. It was just all we were doing is creating a bubble. And sure enough, right after that, we created the housing bubble. Then we had the GFC, and it's kind of been on a downhill road ever since 2004. So I created my website. So from 2004 to 2010, I was learning on my own. And then I wrote a book because there wasn't any, how to invest in gold and silver with a focus on mining stocks. So the second half of the book is understanding mining stocks. And it's a very thorough book. So it's really good at helping you to understand how to analyze mining stocks, how to understand the risk. And then after I wrote the book, I created my website because there wasn't any websites out there. So the book was to help people. It wasn't really for me to make money. It was to help people, to give them some information. And then when I created my website, it was kind of the same mentality, how to help people get information. So it's called Gold Stock Data. And it's data. Now it's up to 850 gold and silver mining stocks. And it's an ideal tool for identifying, for instance, let's say you want to invest in a mid-tier. My database will show you all the gold, silver mid-tiers there are in the world. And you can just go down the list and then you can do your own analysis. And I rate the stocks, so I give you kind of a head start. So both the book and the tool are very useful tools for investors. I'm not a stock picking service like a lot of newsletter writers. My newsletters do not write up individual companies. I don't have don't do any advertising on my website. So the first 5 pages of my newsletter is always macro. I give lists. There's about 10 lists in my newsletter, but the lists they're just leads. Okay, here you go. So I wrote it for investors. You're an investor in mining stocks. Here you go. Here's a tool. Use it. So that's kind of background. Thanks for letting me explain it.
Between 2004 and 2010, years of independent research culminated in the creation of a detailed book explaining how to evaluate gold and silver mining stocks, something the market lacked at the time. The book covered everything from balance sheet risk to geological considerations, giving new investors a roadmap he never had. Soon after, he launched a website designed as a data-driven resource, eventually cataloging more than 800 global precious metals companies. Instead of offering stock tips or promotional write-ups, the platform provided objective rankings and filters, enabling users to analyze miners by category, size, or potential. It was built not for profit, but to empower others navigating this complex sector.
80% macro, 20% analysis on stocks.
Interesting. Mm-hmm.
Probably. To start off, gold and silver mining stock is not investing. This is speculating. And you're really speculating on one thing, which is the price of gold and silver because that is the driver of the value of these stocks. It's a very unique situation. Gold and silver mining companies do not have competitors. They do not have customers. It's a bizarre business. Newmont and Barrick do not compete against each other. They go out and maybe they'll bid on a property, if they might compete there. But by and large, they don't really compete against each other. They compete against themselves. They basically, when they get the gold out of the ground, there's a willing buyer. They don't have to compete. There's no customers. They're just buyers. And you can sell your gold. You can sell your silver. It's an unusual business. And macro, it's so important because you're not investing in a normal business. You're not investing in a normal business. What you're really doing, you're speculating on the price of silver and gold, and then which company is more well-positioned to achieve that. So 80% of my time since 2004 is spent analyzing the backdrop of gold and silver, because that's the only way you make money. And you have to be a believer, a strong believer that gold and silver prices are going higher. I don't invest for the next 12 months. I could care less about the next 12 months. That's not how you invest in gold and silver mining stocks. You're speculating over the long term, 12, 24, 36 months, because you're chasing alpha. You're not trying to get a 25, 50% return, believe it or not, which you could get in the next 12 months.
Gold and silver miners operate unlike almost any other business. They have no conventional customers, no cyclical product demand, and almost no direct competition. Their value is dictated almost entirely by the price of the commodity they produce. Because of this, buying mining stocks is less like investing in a business and more like speculating on future metal prices. The macro backdrop becomes the dominant variable. Long-term conviction, not short-term forecasts, drives the strategy. Investors pursuing this sector aren't chasing routine returns. They're searching for outlier gains that can take years to materialize, but may produce multiples that traditional equities rarely deliver.
You're speculating on big alpha. You're speculating on baggers. I don't look at anything under a four-bagger. I go four-bagger and above. And the only four-baggers that I look at are stocks that I think have growth. So in my book, I wrote that this is back in 2010 when I wrote my book. I said in the opening chapter, I'm after five baggers. That's what I'm here to do. I want my portfolio to have at least a 500% return. It's total speculation. And who invests like this? Now, if you believe the gold and silver prices are going higher, a lot higher, then you can basically speculate on that outcome, and then you can analyze the stocks. And it takes a while to understand because it's such a unique business on how to analyze these stocks. For instance, juniors, explorers, mid-tier developers, and producers, each category is completely different. In many respects, they have nothing in common. They're like three different separate businesses. And you have to understand each one. It takes time. I think it takes about 2 years to kind of understand it. But it's a lot of fun if you believe in gold and silver prices going higher, then it's like gambling. It's not really investing. It's like gambling, but you have an edge. And I teach people in my book how to have an edge. Believe it or not, there's a way to have an edge, which is fascinating to me that you can actually do that. And it's like Wall Street's completely asleep. Like, for instance, Newmont, when Newmont was at $30, you had an unbelievable edge that you were going to make a lot of money. My target for Newmont's about $350, and they're currently at 90, but they were at 30. So Newmont was a 10-bagger in February of 24, a 10-bagger, and Wall Street was asleep at the wheel, and they didn't see this edge that existed, which kind of blew my mind.
Instead of aiming for modest annual gains, the focus in this sector is on multi-bagger potential, 4, 5, or even 10-fold returns. To achieve this, it's essential to understand the distinct categories within the mining world: explorers, developers, mid-tier producers, and major producers. Each stage represents a different business model with its own risk and reward profile. Learning how to evaluate these segments can take years, but the payoff is substantial for those who persist. When combined with a strong belief in rising gold and silver prices, this knowledge offers an edge that many institutional investors overlook, despite enormous upside opportunities.
In my book, I recommend a pyramid approach, which is similar to what you're saying. So the base of you want to start at the base of the pyramid. Pyramid is wider, so you want to have more allocation at the base. So you start at the base and you want to de-risk your portfolio, diversify your portfolio. So I recommend physical, starting with physical, and then use physical as a base, and then use ETFs and mutual funds. So I have 6 ETFs and 3 mutual funds and physical. So a very strong base. And so because you're going to get a lot of volatility, I believe that a base is really useful. Now, I was doing this over years and years and years. Now we're in a bull market. In a bull market, you can become a little more aggressive. And then as you go up the pyramid above the ETFs and the mutual funds, then you do majors. And then above the majors, you do mid-tiers. And that should be the foundation of your portfolio. And I believe you're going to make 80% of your profit in producers. Because producers can have unbelievable alpha because they can grow in 3 different ways, whereas developers and explorers can only grow one way. And so a producer can just build a really big company and make tons and tons of money, which I've seen happen. And so I believe I'm going to get 80% of my returns in producers. So I want to be overweight producers. So I want to own as many. But the key here is entry price. You make your money when you buy the stock, not when you sell it. So you got to have a good entry price. So I've been doing this for a long time. So I don't buy majors unless they're cheap. But if I can find a cheap major, I'm going to buy it. Cheap majors and then undervalued mid-tier producers. I want to get as many as I can get my hands on, and that's going to give me a really, really solid foundation. And then build on top of that with the high alpha stocks. So your high alpha stocks. Now, I didn't mention small producers. So I've said majors and mid-tier producers. Small producers. That's in your alpha. That's in your high risk alpha. And I don't like small gold producers. They're going to be rare. I'm not going to invest in very many small gold producers. And the reason why is because they're not going to generate enough free cash flow to grow the business. You're just going to get a lot more bang for your buck risk reward on the mid tiers. So I tend to avoid small gold producers and small gold projects. Silver, on the other hand, I like small silver projects. I like small silver producers.
It's because they're all small. Just kidding.
Yeah, that's true. Most of them are small, but the thing is they're rare. Like there's only like 15 silver producers. There's just very, very few of them. But here's the kicker for small silver producers. If you can produce 1 million ounces of silver, 1 million, so all you need is 15 million ounces of silver in the ground, and you can do 1 million for 10 years plus.
Because the mining sector is notoriously volatile, a structured approach is essential. His preferred method begins with a broad, stable foundation: physical metals, ETFs, and mutual funds. Only once this base is secure does he add major and mid-tier producers, which often generate the bulk of long-term gains. Entry price is everything. The profit is captured at the moment of purchase, not at the sale. Mid-tier producers in particular can deliver exceptional growth through expansion, production increases, or operational improvements. Above this foundation sits a smaller allocation to high alpha opportunities where risk is elevated, but potential rewards justify the exposure.
If you produce 1 million ounces of silver and silver prices are at 100, which is my target or higher, and your all-in cost is $50, which is conservative, you're probably going to be under 50 as a break even, you're going to have $50 per ounce in free cash flow. Times 1 million is $50 million in free cash flow. If you get a 10 multiple, you get a $500 million market cap. So for every 1 million ounces of production, you get $500 million. And the kicker here is you become very valuable because you're rare. Anybody that's producing silver out there is not very many. You're going to get eyeballs on you. So I like small silver, but I don't like the small gold. Now we go up the food chain. The next one is the developers. I absolutely love developers. I have about 25% in developers. And the reason why I like developers is because they become producers. They turn into producers. Plus, you can get really big alpha. And so I want to own as many producers as I can get, and a developer can turn into a mid-tier producer. And that's, for me, is where you can really get some good alpha. Now, the problem with developers is so many things can go wrong. So I don't do high allocations on very few developers. And the reason why, in other words, for me, high allocation is 1%. It's hard for a company to get 1% of my money, and very rare for developers to get 1%. They can get 0.5, 0.75, but they're not going to get 1. And the reason why is because they tend to break your heart.
This is the Lason Curve, correct? The Lason
no, it is and it isn't. In the Lason Curve, when you have a discovery, you go up the mountain, and then when you go into development, you go down the mountain. So yeah, it definitely is part of the Lason Curve. But the Lason Curve also says that if that mine gets built, it's going to go straight back up the mountain. So it's not so much the Lason Curve that breaks your heart. What breaks your heart is so many things can go wrong before they make money. The first thing that can go wrong is they can over dilute you, and that's usually what happens. They dilute you. That's the Lason Curve on when they dilute you when they're developing it, and then they dilute you again when they build the mine and they do a bad financing. So dilution usually is kind of the worst one. The next one that usually bites you is they sell before they get to first pour. That one bites you. And then another one that can bite you is they run into permit issues you didn't expect. And then another one is the ramp up. They'll ramp up and they won't hit their targets, or they'll have cost overruns. But put it this way, development stocks, they will break your heart.
Among mining categories, developers offer some of the greatest upside, but also the most ways to disappoint investors. These companies sit between discovery and production, a dangerous phase where financing needs, construction challenges, permitting issues, and cost overruns can erode shareholder value. Dilution is a constant threat, especially when capital is raised poorly. Even successful projects can be sold prematurely or stumble during the ramp-up phase. Despite this, developers remain attractive because those that transition into mid-tier producers can deliver extraordinary gains. Managing risk through small allocations and diversification is key, as the path from development to production is rarely smooth.